Good afternoon. It's Quant Trade Edge, and today is Saturday, April 23rd, 2022. I wanted to do a rundown of homework. The best time to do homework is for me is when markets are closed and I'm not distracted by prices actually moving, and I can be a little more objective. And especially on the weekend, you can take a longer term view looking at weeklies and other longer time frame charts. But our best weapon in trading is to be prepared. You want to already know what it looks like in your head, so when you're flipping through something in the heat of battle, you already have the context in your head. You're not just absorbing it at that moment in time. And that's what makes having a repeatable, consistent homework methodology critical to long term success. So for me, the only markets I really look at are crude, natural gas, gold, silver, copper, Australian dollar, and S&P, Nasdaq, sometimes Russell. And I look at more, but those are my core markets. And I was just going to do the quick run through that I normally just do by myself. I was going to just share with you this homework routine that I have in hopes that it helps you develop your own routine that works based on the products you trade and the markets you look at. So again, hit that like button and subscribe if you like this content. We are growing really, really fast, and I appreciate all of you. Let's start with crude oil. And crude oil is in a very perfect balance. You know, we're right in the middle of this range. We have what's called a 3-bar pattern, where yesterday's range is covered inside the previous 2 bars range. It's getting tighter and tighter. In fact, I feel like looking at our ATR indicator, 0.65. So, this is ATR 3 divided by ATR 20, and typically something under 0.7 is ready to break out, and we're at 0.65. So it is kind of a crapshoot which way it goes. There's not really any clue here per se. If we look higher time frame on a weekly, the structure we have is A, B, C down, and we've had 1 bar up off of there and just this bar right here. So that doesn't really offer us a clue either. I'd stay open-minded to possible trade either way. Getting a little more micro on the 120 minute, we had this hoagie that pretty much lasted 12 hours, from this 3 a.m. bar till the end of the day. And although we pierced it, I wouldn't give that a whole lot of weight, because it was basically this right here on the 5-minute chart after 3 p.m. after the S&P closed. This little 5-minute boom went down and reversed. So it could be a hoagie breakout fake out, where it's a trap, or we'll just wait and see. And I don't plan to be too active on Sunday night or Monday morning, so that'll give it time to fill out and give us more direction. Moving on to natural gas, if we pull it back to a weekly, you'll see that we are at a very key level of support. This high from October of 2021 is right where we pulled back to. This spike up here I give less validity to, only because it happened on a day of contract expiration. And typically on those days, things get pushed around and manipulated for reasons outside of just the market for that particular contract delivery. So want to have a long bias here, just being up against that support, but we need to find something to support it. And this is pretty strong momentum down. And remember, a swing is going to end one of 2 ways, either with a climax or with a divergence. And the divergence is the one we look at more, because climaxes are just, they're typically wide range, a little harder to catch. The anti-climax pattern is one good way to catch a climax, but otherwise it's a lot more difficult, and the risk is higher. But one thing I noticed on this chart is the 240 minute has a deceleration pattern that's starting to form. And again, a little bit of caution here, because a 240 minute is 4-hour bars, 5 to 9, 9 to I guess it resets it at the pit open, so that makes the bars even more janky. This bar represents 3 hours, this bar represents 4 hours. This bar represents 4 hours. This bar represents 1 hour. Well, that's weird. 12 to 1:30. This bar only represents 90 minutes. So I would discount this this deceleration pattern just based on the way that we're not looking at uniform bars. And down on the 5 minute, again, it looks like we have this little consolidation here. There's just not much that we can hang our hat on, and we don't want to just buy blindly into this support. Perhaps one thing we can do is wait to take out this low and then look for a short-term U-turn, and that might be a way to get long in natural gas. Gold is the only market that's showing a decent divergence. There was so much momentum on Friday that we don't have a lot of divergences. We just have new momentum lows in most cases. Here on the 120 minute, you can see that we made this low here at 41, this low here at 38, this low here at 28, and each time we got a higher low on the RSI. Within that 120, we currently have a 5-minute ABC up with a high of 1942.30. So that would be a U-turn point to play this divergence. On the daily, we have this breakdown of a trend line, but to me it's not really confirmed until you take out that low. So assuming we gap up and show strength, this U-turn is probably a good spot. Silver, now this was our P1 pattern, and we only got the one leg up. We didn't get our typical 2 legs on that, and we got pushed back down below the low over here. But on the 240-minute chart, which I have highlighted over here, and I'll blow it up, using the LBR 310 oscillator, we've got the startings of a 3 pushes pattern. Each push is into the Keltner channel. These 2 pushes are kind of close to each other. You typically want a little more space to form between those humps so that rather than being sharp down, it's more wedge looking down, like that. And that's kind of more consistent with divergences forming. But silver is a market that likes to spike around. So, if we go back here, we can see that this top was made with anticlimax patterns. We got an anticlimax here and a deceleration near the top. So silver is, it's not for the faint of heart. It doesn't always give you divergences. It tends to climax more. So what I would be looking for on silver would be, in particular, if we can take out this low, this 2404 and a half, and come back above it and leave a trap, then that would set up probably, if by that time we have some divergences forming, then a 5-minute U-turn or a 15-minute U-turn might be a reasonable entry for that. Moving along to copper, the other yellow metal. So pulling this out to a weekly, there's too much noise here. I should take some of this stuff off. But the thing that caught my eye was the divergence on the weekly from this high made in May of 2021 right here, and then the higher high that we just made in March of 2022. So, here you have a higher high, and there you got a much lower low. So that's not a good sign for continued strength. It could mean we fall back into the range and consolidate more. Could be even more sinister. But taking it down to a daily, depending on, if you want to connect, well, let me show you the way you're supposed to do it. Starting at this point, just swing out until you touch something. And, well, not counting that because we're trying to judge that. So based on that, we've broken the trend line. Same thing here. So it's kind of the same either way. If you go from this point to this point or this point to this point, either way we've broken it. And again, remember, I like to see us go down lower, below that low to trigger the break. Make sure the MACDs have rolled over. I'm pretty sure they have. Yeah, just from the look of it, you can tell that that would have already happened. So it already happened before that last swing. But think about this on, say, 240 minute. Oh, that's interesting. We have a anticlimax on the 240. So assuming we take out this low and confirm that daily trend break, we could easily put in some sort of ABC to go back and retest, whichever one of these trend lines it wants to, and that could set up a good short that would have asymmetry in the reward relative to the risk. So, again, I have no idea how this is going to play out. That's just my plan A. If it does exactly that, taking out the low, putting up a beautiful ABC, I'm going to be ready for it because that would be an ideal situation. It can do a variety of other things, and if it does, I can just sit out. I don't have to play. So that's the beauty of doing your homework and figuring out what you would like to see, in terms of what would be a good setup. And if that doesn't play out, then just stay away. Let's see, after copper, Australian dollar, nothing going on there. If you take this out to a weekly, it doesn't have divergences. On this high, we had momentum here. On this high, we had significantly higher momentum there. So that's fine. But on the daily, we are breaking a trend line. We're right down to the 61.8 fib of this last move. Not exactly sure what it's going to do at this point. It's got a lot of downside momentum. It just hit new momentum lows for this entire period of time, and we did break this trend line. Rather just watch this market at this point. Nothing clear to me on it. On the S&P, now on the daily, this is a new momentum low, lower than we've seen in quite a while. In fact, we can try to go back and see when have we seen momentum like this. Nowhere on this chart, just to maybe see how climactic that is. I wonder if we have to go back to COVID to see it. Right there, September of 2020. Okay, that was post-COVID. This 2-day rate of change of negative 4.88, almost 5. Yeah, oh, wow. In COVID, we had negative 6, negative 6, negative 9.5, negative 15 over there. So, yeah, we just haven't seen this kind of momentum since COVID. So that's telling us something. Now the key is going to be, there's a couple of lows here at 41.38 and 41.3875. So that's going to be a key level to watch out for. And then the absolute low here is just shy of 4100. It is 4101.75. This is on the continuation. Sorry. On the June contract, the low is 40.94.25, and this little support area is 41.30. Call it 29.50, 30.25. It's about 41.30. So that's what to keep an eye on. Don't see any divergences forming yet. We pretty much went out on the lows. One of a few things is going to happen. We're either going to gap up, in which case we have to really ask ourselves, is the gap significant enough to have trapped people and continue its momentum, or is it going to eventually fade and fail and give us a test lower? We could gap down, and if we gap down, is it climactic? The 2-period RSI closed at 7.1, which isn't even as oversold as we like to see. I went ahead and put these little indicators on there. You can see in the recent past, right here was RSI 2 less than 5. Next day bottomed. Right here is RSI 2 less than 5. In this case, he gapped up and went up all day. But that wasn't a 20-day low. And then the same thing on the highs. This was a high. We had one day of consolidation and continue. And then our most recent high was also a day of RSI 2 greater than 95. So since then, we've actually been more moderate. This high was only 87. This low today is only 7.1. So don't quite have that kind of extreme reading yet. Interestingly, though, if you go to the weekly, we did have an anticlimax. So, we basically had an anticlimax at the end of January, which gave us a couple of bar bounce. We had an anticlimax here, which triggered and then pretty much pulled back but held. This took several weeks to play out. This is what was very grinding on the sentiment. And we have one here. And, it's right on the lows, so we don't know. We still need a weekly bar to form. We need a green weekly bar to form to trigger it. So in both of these cases, well, actually not here. Here it took one bar to form. Here it was already green. So it's, we can still put tails down there, or, still got to be very, very careful. And the ranges are a lot more, a lot wider over here to see what's going to happen. And then let's just quickly look at the NASDAQ, because it's slightly different. It has, worse momentum. And, same thing here. We've got very low momentum, similar to where it was here where it bottomed, negative 5.36. 20-day low momentum, no divergence in sight. It's going to be extremely key for us to see if we hold this or not. This level is 12,942.50. That's about 350 points lower. And that's going to be key to hold. For us to think that in any way that this is a bottom, that level has to hold. Because what basically happens on a, if this were a completed 5-wave down pattern, let's blow it up. Yeah, it doesn't favor that count. If this were to be a bottom, then this move up here would be a wave 1 move. And if you're able to make a higher low, and we know that the sentiment is way worse now than it even was at the bottom here, that would be classic of a wave 2 bottom if that was a higher low. So all eyes are on this level for the NASDAQ to see if we go make a lower low or save that low right there. And given the momentum, we definitely expect a lower low to yesterday's candle, but that doesn't mean it has to go all the way down below this low from March 15th. So we'll just keep an eye on that. And again, for most of these markets, I'm happy to sit out and watch when things get this crazy. The gold divergence is something I'll keep an eye on. The copper back testing the line looks reasonable. Natural gas, again, it's not something that's dictated by the stock market and whatever type of liquidity issues are happening in the stock market. So that's also a safer, in my opinion, safer place to hide out. But anyway, I just wanted to share this homework process with you and hope that you develop your own. And that's pretty much it. It's Saturday. I feel like the earlier I do it, the longer it has to settle into my brain, and I can think through things. And then when I'm reactive on Monday, the context is better settled in my head. So anyway, hope this helps. Please drop a like, subscribe, and let's keep this community growing.